Okay, Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh, ma'am and friends. We are from Group 6. We'll do our presentation today, and our material is focused about audit of the capital acquisition and repayment cycle. Next. So, what we're going to present today, here are the four material that we focus and we will going to explain in this presentation. The first one is accounts in the cycle, notes payable, owner's equity, audit of capital stock, and paid in capital. Next. But before we do our presentation, let me introduce my team members. They are me, Winesa, Dwinda, and my friends, Yasmin, Ananta, Furqan, Giffari, Ibnu, Toriq, and Zakya. Next. Okay, the first slide, I'll explain about the capital acquisition and repayment cycle. So, as we can see and we know that this capital acquisition and repayment cycle is the final transaction cycle, which concerns about the acquisition of capital resources through interest-bearing debt and owner's equity, and also the repayment of capital. And also, this cycle includes the payment of interest and also dividends. So here are the four characteristics of the capital acquisition and repayment cycle. For the first characteristic is few transactions affect the account balances, but each transaction is often highly material. So we can take a look for the example, it's bonds. So bonds are infrequently issued by the company, but the amount of a bond issue is normally large, and their size makes it common for auditors as a part of verifying the balance sheets accounts to verify each transaction taking place in the cycle for the entire year. And then audit schedules for most accounts in the cycle include the beginning balance for every account, every transaction that occurred during the year, and also the ending balance. And the second is the exclusion of a single transaction could be material in itself. So, as a result, the auditor's primary emphasis in auditing this account is often on the completeness and also accuracy balance related to the audit objectives. And the third one is there is a legal relationship exists between the client entity and the holder of stock and the holder of bond or similar ownership documents. So we know that auditor should determine whether the client has met the requirements of debt or equity agreements. So in the audit of the transaction and amount in the cycle, auditor must take a great care to make sure that the significant legal requirements affecting the financial statements have been met and adequately presented and disclosed in the statement itself. And the last is there is a direct relationship exists between the interest and dividends accounts and also debt and equity. So we know that in the audit of interest-bearing debt, auditors should simultaneously verify the related interest expense and interest payable. And then this is also true for the owner's equity, dividend declared, and dividend payable. So next. So we come up to the next material. It's about accounts in the cycle. So as we know, the accounts in the company's capital acquisition and repayment cycle actually depend on the type of business the company operates and how its operations are financed by a company. And as with other cycle, actually, cash, we know that the cash is an important account in the cycle because both acquisition and repayment cycle of capital affect the cash account. And here, the unique characteristic of capital acquisition and repayment cycle affects also how auditors verify the account in the cycle, and this cycle often includes these accounts. There are notes payable, contracts payable, mortgage payable, bond payable, interest expense, accrued interest, appropriations of retained earnings, treasury stock, dividend declared, cash in the bank, capital stock. It is common capital stock, and then capital preferred stock, paid in capital excess of par, donated capital, retained earnings, dividends payable, proprietorship capital account, and partnership capital account. So here we can take a look for the example. In determining the test of details of balance for notes payable, auditor should consider about the client's business risk, performance materiality, their inherent risk, control risk, and also the results of test of control and substantive test of transaction, and the result of substantive analytical procedures. And we know that auditors often set performance materiality at a low level. Because what? Because it is usually possible to complete audit the account balance and transaction affecting the notes payable account balance itself. And auditor normally most concerned about the completeness objective for notes payable account balances and the completeness objective for notes payable disclosure, such as collateral and also covenant restrictions for notes payable. So, in order to get the best understand the audit procedure for many accounts in the capital acquisition and repayment cycle, representative accounts that are significant parts of the cycle for a typical business are included in our today's explanation. So that's all for me. For the next slide will be explained by my friend to Zakya. Time is yours.
Okay, thank you, Winesa. The next material is about notes payable. A note payable is a legal obligation to a creditor, which may be unsecured or secured by assets and bears interest. The principal and interest payments on the notes must be made in accordance with the terms of the loan agreement. For short-term loans, a principal and interest payment is usually required only when the loan becomes due. For loans over 90 days, the notes usually calls for monthly or quarterly interest payment. And this figure 22.1, shows the accounts used for notes payable and related interest. Auditors commonly include tests of principal and interest payment as a part of the audit of the acquisition and payment cycle. Because the payments are recorded in the cash disbursement journal, but in many cases, because of the relative infrequency, no capital transactions are included in the auditor sample for tests of controls and substantive tests of transaction. Next. And next is the objective of the audit of notes payable. The first one is internal control over notes payables are adequate. And the second one is transaction for principal and interest involving notes payable are properly authorized and recorded in accordance with the 6th transaction-related audit objective. And the third one is the liability for notes payable and the related interest expense and accrued liability are properly stated as defined by 7 of the 8 balance-related audit objective. And the last one is disclosure related to notes payable and the related interest expense satisfy the 4 presentation and disclosure audit objective. Next. And the next material is about internal controls. The first one is proper authorization for the issue of new notes. It's a responsibility for the issuance of new notes should be vested in the board of directors or high-level management personnel. And the second one is adequate controls over the repayment of principal and interest. The period payments of interest and principal should be subject to the controls in acquisition and payment cycle. And the third one is proper documents and records. This includes subsidiary records and control over blank and paid notes by an authorized person. And the last one is periodic independent verification. Periodically, the detailed note records should be reconciled with the general ledger and compared with the note holder's records by an employee who is not responsible for maintaining the detailed records. Tests of notes payable transaction involve the issues of notes and the payment of principal and interest. These audit tests are a part of tests of controls and substantive tests of transaction for cash receipts and cash disbursement. And previous slide, please. The substantive analytical procedures are essential for notes payable because tests of details for interest expense and accrued interest can often be eliminated when results are favorable. Next. And this table is table 22.1, illustrates typical analytical procedures for notes payable and related interest account. And next. Okay, this is figure 22. This figure illustrates a typical schedule, including detailed information of all transactions that took place during the entire year for the principal and interest, the beginning and ending balances for notes and interest payable, and descriptive information about the notes, such as the due date, the interest rate, and the assets paid as collateral. When there are numerous transactions involving notes during the year, it may be impractical for auditor to obtain such a schedule. In those situations, auditors are likely to request the client to prepare a schedule of only those notes with unpaid balances at the end of the year, showing a description of each note, its ending balance, and the interest payable at the end of the year, including the collateral and interest rate. Next. And this is the continue for previous slide, figure 22.2. Okay, that's all from me. Back to Winesa.
Okay, thank you to Zakya. And for the next slide will be explained by Yasmin. Yasmin, there is yours. I mean to Giffari, time is yours.
Thank you, Winesa, for the opportunity. The next topic will talk about the identify the primary concern in the audit owner's equity transaction. There is an important difference in the audit of owner equity between a publicly held corporation and closely held corporation. The first is about closely held corporation. The only transaction involved in the owner's equity section are likely to be the change in owner equity for the annual earnings or loss and the declaration of dividends, and auditors spend little time verifying owner's equity even though they must test their corporate records. And the next is we talk about the publicly held corporation. However, the verification of owner equity is more complex because of the larger number of shareholders and frequent changes in the individual holding the stock. Verifying the major owner equity account in a publicly held corporation, including capital and common stock, paid in capital in excess of par, and the last is retained earnings and related. Okay, the next topic, maybe as you can see in the slide, this is about the owner equity and dividend account. This is like provide an overview of the specific owner equity account discussed and the objective for Each is to determine whether the first is internal control over capital stock and related dividend are adequate, and then is owner equity transaction are correctly recorded as defined by the 6 transaction related audit objectives, and then owner equity balance are properly recorded as defined by the X balance related audit objectives and properly presented and disclosed as defined by the 4 presentation and disclosure related audit objectives for owner equity account. Okay, the next topic we talk about the internal control in the owner equity transaction. Maybe as we know, internal control is one of the important thing that company should thinking about this, because it's because with this we can make sure how the company performance. Internal control is about proper authorization of transaction. Because its owner equity transaction is probably material, many of these transactions must be approved by the board of directors. And the following types of owner equity transaction usually require specific authorization. The first is about issuance of capital stock. The authorization includes the type of equity to issue, like such as preferred or common stock, number of shares to issue, per value of the stock, and so on. And the next we talk about repurchase of capital stock. The repurchase of common or preferred share, the timing of the repurchase, and the amount to pay for the shares shall all be approved by the board of directors. And the next is declaration of dividend. The board of directors must authorize the form of dividend, such as cash or stock, the amount of the dividend per share, and the record and the payment dates of the dividend. The next internal control is about proper record keeping and segregation of duties. When a company maintains its own record of stock transaction and outstanding stock, the internal control must be adequate to ensure that the first actual owner of the stock are recognized in the corporate records, and the correct amount of dividend is paid to the stockholders owning the stock as of the dividend record date. And the last is the potential for misappropriation of the asset is minimized. As a control over capital stock, most companies maintain stock certificate book and a shareholder capital stock master file. A capital stock certificate record the issuance and repurchase of the capital stock for the life of the corporation. And the next is about a shareholder capital stock master file is the record of the outstanding share at any given time. Okay, the next we talk the internal control affecting dividend payment may include the first one is divided checks are from the capital stock certificate record by someone who is not responsible for maintaining the capital stock record. And then is after the checks are prepared, there is an independent verification of the stock name, amount of the checks, and a reconciliation of the dividend checks with the total dividend authorized in the minutes. And next is a separate impress dividend account in use to prevent the payment of a large amount of dividend that was authorized. Okay, the next internal control is about independent register and stock transfer agents. This is we talk about a company with stock listed on a securities exchange is required to engage an independent register as a control to prevent the improper issue of stock certificates. The responsibility of an independent register is to ensure that stock is issued by a corporation in accordance with the capital stock provision in the corporate charter and the authorization of the board of directors. And then we talk about the stock transfer agent. Most large corporations also employ the service of a stock transfer agent to maintain stockholder records, including those document transfer of stock ownership. The employment of a transfer agent helps strengthen control over the stock record by putting the record in the hands of an independent organization and help reduce the cost of keeping records by using a specialist. Okay, that's all from me. I give back to Winesa.
Okay, thank you, Giffari. And for the last slide will be explained by Yasmin. So, Yasmin, time is yours.
Okay, thank you, Ines. The next subject is audit of capital stock and paid-in capital. The auditor have most concern with the 4 points. The first is existing capital stock transaction are record. There is completeness transaction related objective. The auditor can confirm with that person whether any capital stock transaction occur and the accuracy of the existing transaction, and then determine of the all those transactions have been recorded. And the second is record capital stock transaction occur and are accurately recorded. There is occurrency and accuracy transaction related objective. The accuracy transaction related objective can ordinarily be tested by examining the minutes of the board director meeting for proper authorization. And then the auditor can readily verify accurate recording of capital stock transaction for the case by confirming the amount with the transfer agent and then tracing the amount of the record capital stock transaction to cash receipt. And the third is capital stock is accurately recorded. There is an accuracy balance related objective. The audit by verifying the amount of record transaction during the year and adding them to the subtracting them for the beginning balance in the account. And then a major consideration when auditing the accuracy balance related to the objective for a capital stock is verifying whether the number of shares used in the calculation of earning per share is accurate. And the fourth is a capital stock is properly presented and disclosed. There is all for presentation and disclosure objective. The auditor should determine that each class of stock has a proper description, and then for the including the number of share issue and then outstanding and any special right of an individual class. Next. Okay, the next is audit dividends. In the audit dividend have to concern with the first is the emphasis is on dividend transaction rather than on the ending balance. And then second is the exception is when there are dividends payable. For the audit dividends, there is a most important objective. The first is record dividend occur or occurrence. The second is existing dividends are record or we call completeness. And the third is dividends are accurately recorded or accuracy. The fourth is dividends are paid to stockholder that exist currency. The fifth is dividends payable are recorded. And then we can call the completeness or as a number 2 before, and then the last is dividends payable are accurately recorded is accuracy like in number 3. And then for the audit dividends, the accuracy of the dividend declaration can be audited by recalculating the amount on the basis of the dividend per share times the number of shares outstanding. And then test of dividends payable should be done in conjunction with the declared dividends. Any unpaid dividends should be included as a liability. Next. And next is audit of retained earning. For the audit retained earning, to begin the audit of the retained earning, the auditor first analyze retained earning for the entire year. And then the auditor schedule showing the analysis which is usually a part of the permanent file includes a description of every transaction affecting in the account. And then to accomplish that, the audit of the credit to retained earning for net income for the year, or we call the debit for a loss, auditor simply trace the entry in the retained earning to the net earning figure on the income statement. This procedure must be take place fairly late in the audit after all adjusting entries affecting net earning have been completed before. Okay, maybe that's my subject. I give back to Winesa.
Okay, thank you so much, Yasmin. Okay, everyone, that's all our presentation today. And thank you so much for the attention. And we can do the Q&A session through our Zoom meeting later. And we say thank you so much and Assalamualaikum warahmatullahi wabarakatuh.